Hi students, how are you? In today's session, I am going to have a lecture on taxation and deferred tax. That is taxation, income tax, SLAS, sorry, IAS 12 and LKAS 12 and LKAS 12, right? Income tax, right? So the if you see the income tax normally income tax account debit, income tax account payable is credit. That is the accounting treatment for the income tax payable on the certain income to the government of the country. Right? Normal entry is income the tax charged for the year is the tax payable for the year, right? We have to add with the previous year's payable and paid and everything. Calculation is done and payable for the year and paid for charge for the year. The income tax charge for the year goes to the income tax, right? Payable and receivable is the some other normal receivable payable account, right? So for that we will do one sum on the income tax, right? Income tax, normal income tax, right? Without deferred tax, normal income tax, right? We will do a question on that. Okay, in the question they says the following trial balance extracted relates to the Charles as a 31st March 2015. Current tax is payable. It shows payable. Current tax payable 400. Okay. Current tax payable 400. Right. It showed the current tax payable 400. And following notes are also relevant. A provision for current tax for the year ended 31st March 2015 of 3.5 million is required, right? The credit balance, the tax shown in the extract of the balance sheet showed the extract of the trial balance showed the 400 payable current tax, but whereas the following the notes were telling a provision for current tax for the year ended 31st March 2015 of 3.5 million required, right? Then we will say statement of financial position, statement of financial position, right? In the statement of financial position we will show tax payable under the current liability, we will show uh, tax payable payable is 3.5 million, 3.5 million, right? In thousands, okay, in thousands, 3.5 million, because they have told us the provision for tax, current tax for the year ended 31st March 2015 is 3.5 million is required. The balance on current tax in the trial balance represents the under provision or over provision of the tax liability for the year ended. The 400 shows the under provision or over provision. So charge for the year, that is statement of profit and loss, right? Statement of profit and loss. We have to show, right? We have to show profit before tax, tax, some it is a taxation is this. Taxation is 3,100. Over provision 3,100 is the current year, right? And profit after taxation. Yes. This is the way we have to show, because this is in the trial balance they told brought forward balance taxation. Okay, brought forward balance was 400, right? They wanted to make us carried down value 3,500, 3,500, 3,500. So brought forward again, carried forward, carried down and brought down is 3,500, right? Last year over provision had been made. So current year charge is difference between the 1,000 P and A. Right? This is the current year charges. Right? Tax payable current year. We have charged it to the P&L and credit to the this is what we are charging. Okay. Question number 2. Okay. Question number 2. The TK purchase an item of property, plant and equipment on 1st January 2015 for 5 million. It was estimated that it had a useful economic life of 5 years, but according to the tax authority, had a 50% tax allowance on its first year and 20% reducing balance thereafter. TK made an accounting profit of 2 million for the year, which is expected to continue unchanged for the next 2 years. Income tax rate is 20%. Ignoring deferred tax, calculate the profits after tax for Tracy for each of the 3 years ending 31st December 2015 to 2017. This is right. This is the normal calculation of the what do you call profit and loss, right? Normal calculation of profit and loss. If you say year 2018, 17, 2016, 2015, right? 15. 2015, 16 and 17. Okay, you will see right? 15 and 2016 and 20. Profit before tax. Profit before tax, right? And here we will say income tax. Income tax less income tax. Okay, income tax. Then we will arrive at, right? Then we will arrive at profit after tax. Profit after tax. Profit after tax. Right? This is the P&L. Right? Thereafter, we have to calculate, right? What you call, we have to calculate the workings, right? This is workings. In the workings, okay, the workings, we have to calculate the what you call profit before tax. Profit before tax, right? 2015, 2016, 2017, right? Wait. 2015, 2016 and 2017. Okay, then we will right, profit before tax and depreciation. Accounting, if we want to prepare the tax at the depreciation, right? Because from profit before tax arrived, we have arrived this profit before tax after deducting the depreciation, no? So we have to add back the depreciation to the profit before tax, right? Profit, right? Then you will arrive at balance, right? Thereafter, less less tax allowance, tax allowance, tax allowance, right? Tax allowance we have to deduct. Then temporary difference, right? This is a tax allowance, and you will say some other thing, and we will say tax. Therefore, tax at the rate of 20%, right? So here they say what they said. They have said the person purchased the TK purchased the uh, property, plant and equipment for 5 million, right? And depreciation allowance is for 50% for the first year and thereafter 25%. So we will go for the what you call the workings. In the workings, calculation of uh, One is depreciation, depreciation and calculation of what you call tax allowance. Tax allowance. Tax allowance, right? Calculation of depreciation and tax allowance. In the depreciation, they said 5 million worth of 5 million in thousands, right? This is in thousand. 5 million, 5 million worth of good property, plant and equipment. Property, plant and equipment was purchased, and useful life is 5 years. 5 years. 5 years, right? 5 years in that sense. 1,000 is the depreciation for the year. For the tax allowance, for the tax allowance, this is for the 2015, right? This is for the 5 million, 5 million into 50%, 50%. That is 2,500,000. 2,500,000. Then again the balance is 2,500. This is in 2016 into how much? 20% or 25%? Thereafter reducing balance 20% at the rate of 20%. If it is 20%, it is 500. 500, right? 500, then it is 2,000. It is on 2017, right? 2,000. 2,000 into 20%, because it is on reducing balance. The tax is calculated on the reducing balance. They have given like that. Okay. Then this is on 20% into 2,000 is 400, right? 400. Then balance is 1,600. Okay. Here this is called as tax base. Tax base. This is called tax base, right? This is called tax base. Tax base. This also called tax base. Tax. Right? This is called tax base, right? So if you keep it in your mind, keep it in your mind, that is what is the tax base, right? This is the tax base, because we are calculating the tax in based on this. On this only we are calculating. We are calculating this tax on this. So that's what we are saying, tax base. Okay. So keep it in the mind. Later on, it will help you, right? This is depreciation. This is depreciation. Okay. So here they says tax depreciation, profit before tax is, how much is the profit before tax? Profit before tax is 2 million. 2 million per year, right? 2 million profit before tax. This is profit before tax 2 million. This is profit before tax 2 million, right? Here also profit before tax 2 million, profit before tax 2 million, profit before tax 2 million. Okay. What is the depreciation? Depreciation is 1,000 for every year, straight line method, right? 1,000. So we have to add back the depreciation to the profit before tax. So this is 3 million. So this is also 3 million. This is also 3 million. Okay. Tax allowance. Tax allowance first year 2500. This is the tax allowance for the year, right? This is the tax allowance for the year. This is the tax allowance for the year, right? Tax allowance, right? 500. This is tax allowance for, this is tax base, this is the tax allowance, right? 400. So otherwise you say this is tax allowance, right? Tax allowance, tax allowance calculated. Okay, this is also tax allowance. This is also tax allowance, right? Tax allowance. Okay, so we have to deduct this one. So if you deduct this, you will get 500, here 2500, here 2600. If you tax is 20%, 20% on 500 is 100, 20% on 2500 is 500, 20% on 2600 is 520, 520, right? So this is the tax. So income tax, we have taken profit before tax. Now we have calculated the tax. So now we are going to deduct the tax. Tax 100. This is 500, right? This is 520. So profit after tax was, this is 1,900,000 and this is 1,500,000 and this is 1,480,000 profit after tax. This is the statement of profit and loss. This portion is statement of profit and loss, right? So this is a profit and loss. So in the financial statement, that is statement of financial position, right? In the statement of financial position, you will say current liability, current liability. Under the current liability, we will mention what you mention. This is the income tax. Income tax of 2015 and 2016 and 2017, right? 100, 500 and 520. This is how you will work it out. This is the answer for question number 2. Understood? How we derive? This is the normal way of calculation of tax, right? Now we haven't gone into the deferred tax. We haven't yet gone into the deferred tax. Now we are calculating the normal tax only. Here workings is there, profit before tax. We are adding the normal accounting depreciation, and we are then after that we are deducting the tax allowance given by the income tax department. So we will arrive the taxable profit. This is the taxable profit. then 20% we are charging. This is taxable profit. Taxable profit, right? So 20%, then 100, 500, 520. So profit before tax is this, income tax is this, then profit after tax. In this is mentioned in the statement of profit and loss, right? Statement of financial position, current liability, under the current liability, income tax, 100, 500, 500. Okay, understood? Understood? So we will move into the third question. So I am going to raise this side. Okay, this side I am going to raise. You have taken down the notes, no? If you want, you can take it down. Just pause it and you can take it down. This is question number 2, right? Question number 2, right? Question number 2, right? Now we are going to move into the question number 3. Question number 3. Question number 3, right? Again, TK purchase, same question, right? This is without the deferred tax. This is without deferred tax. Without without deferred tax. Tax. Right? This question is without deferred tax. Right? This question with deferred tax. With deferred tax. This is with deferred tax. Okay? With deferred tax. Okay? So in the question, this is TK purchased an item of property, plant, equipment on 1st January 2015 for 5 million. It was estimated that it had a useful economic life of 5 years. But according to the tax authority, had a 50% tax allowance in its first year and 20% reducing balance thereafter. TK made an accounting profit of 2 million for the year, which is expected to continue unchanged for the next year, next 2 years, right? Income tax rate is 50%, 20%, right? So right, so we will move. So here with the deferred tax, we will say, oh sorry, we'll say this is this is 2017, 2017. This is 2016. This is 2015. Right? This is 2015, 2016, and 2017. Okay. Here we will say profit before tax. Profit fit before tax, right? Profit before tax, less income tax, income tax. Okay, in the income tax you will have a current tax, current tax, and second one is current tax, and other one is defer movement in deferred tax, movement in deferred tax. DFE, right? Deferred tax, right? So here you will arrive at temporary difference, right? 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 So no, not right. Here you will say profit after tax. Profit after tax. Okay. Hereafter we will do the variation of assets. Right? In the assets, carrying value. Right? Carrying value. Carrying value of the asset. Next one is tax base. Tax base. Tax base. Right? Then we will arrive temporary difference. Difference, right? Temporary difference, right? This is also 2015, this is 2016, and this is 2017. These figures are mentioned here, right? 2015, 2016, 2017. This is of course for the asset, right? Asset, okay, right? Carrying value is there, tax base is here, temporary difference is there, then deferred tax point of 20%. Temporary difference in deferred tax, right? Difference, deferred tax point, right? And deferred tax liability or asset, asset, deferred tax liability or asset, right? Let's see. Okay, here we have This is the same question we have done here without deferred tax. For your understanding, first is without deferred tax. Third column, second is without deferred tax, and third is with deferred tax. Right? So here profit before tax is 2 million. We know already. Right? 2 million. 2 million, 2 million, and 2 million, right? Income tax, current income tax, we have already calculated. This is the current income tax, the tax allowable. This is the tax. This is called current income tax. Current income tax. This is, so we can take the current income tax, that is 100, right? 500, right? And 520, 520, right? Movement in the different tax, deferred tax, right? Here we will write movement in deferred tax, that is 2015, 2016, and 2017. Okay. Closing balance, closing balance, this is opening balance. If you deduct from this, the difference is movement in deferred tax, movement in deferred tax, right? DT means deferred tax, right? So here we will say carrying value. What is the carrying value? Carrying value is, this is the carrying value, uh, sorry carrying value is our property plant and equipment which we have bought is 5 million, right? 5 million, right? 5 million, and we have calculated the depreciation per year annum. This is depreciation per annum, right? Per annum, right? Straight line method. Then we are going to equally, we have to distribute among the this thing here, 2000, right? So carrying value is 5000, 5000 purchase value minus 1000 is 4000 is the carrying value, right? For 2015. For the 2016, 4000 minus 1000 depreciation, 3000 is the carrying value. 3000 is the carrying value. On 2017, it is 2000 is the carrying value, where we have deducted 1 million for depreciation, right, from each. The tax base, already I have explained you, this is the tax base, right? This amount is the tax base, this amount is the tax base, this is the tax base. So tax base is 2500, 2500, and 500, 500, and 400, 400, right? So temporary difference is, this is 1,500,000. This is 2,500,000. This is 1,600,000. Right? 1,600,000. So if you apply 20%, this is 300. This is 500. Okay. 300. No? 300. This is, sorry, sir, not the 500. This is 2,000, right? Tax base is this 2,000. Sorry, 2,000, and this is 1,600. Tax base 1,600, right? 1,600. So when you deduct this carrying value from carrying value, tax base is 500. Temporary difference. This is 1,000. This is 400, right? 500,000. If you apply 20%, this is 100, right? This is 20% of 200. This is 80, 80, right? 80, right? Whether this is, they ask whether, first of all you have to see the step 1. Step 1 is ascertain the temporary difference in the deferred tax. Temporary difference, the temporary difference in deferred tax. Second one is deferred tax, calculation of deferred tax. Third step is deferred tax asset or liability. Identify whether deferred tax is liability or asset. Here, if the carrying value is greater than the tax base, then it is the liability. Carrying value is greater than tax base. Then it is the current liability. Current liability. Here also, carrying value greater than tax base. Carrying value greater than tax base. This is also current liability. This is here also, carrying value is greater than tax base. Then this is also current liability. Okay, it's called current liability. Okay. CL in the sense current liability. Okay. Here closing balance is 100. Deferred tax closing is 100. Opening nothing. Here opening is 100. Closing is 200. Here closing is 200. Opening is 80. Closing is 80. Opening is 200. Closing is, here closing become opening of next year. This closing become the opening of the next year, right? So difference is 100. Here liability is increased or decreased? Increased, right? Okay, this is the closing balance 100. From opening balance it is increased, right? Increased. Okay, Sorry, sir, sir. Wait. Sorry, this one is 1000. I made a mistake. 1500. Okay, 1500 in the sense 300. 300. This is also 300. This is also 300. Okay. Right? Here it is increased. Increased by 300. Increased by 300. 4000 minus 2500 is 1500. Right? So here 200 closing, opening is 300, opening is 300, closing is 200. Here closing is 300, opening nothing, then movement is 300 plus. Here opening is 300 and closing is 200. There is a reduction of 100, right? 100, reduction of 100, right? Here opening is 200, closing is 80, reduction of 120. There is a less. Reduction of 120, right? So movement in deferred tax is, first one is 300, second one is 100 minus 100, third one is 120 minus, then 400 minus 1600, 2000 minus 1600, 1600. This is the profit and loss. This is called statement of profit and loss. This is up to this point, right? Right? Understood? Statement of profit and loss, right? So statement of profit and loss, statement of financial position, we will give you right here. What you call non-current assets, non-current asset, right? Under the non-current assets, 2015, 2016 and 2017, and current assets. Under the current assets, we will say income tax. Income tax. How much the income tax? Huh? 100, 100. See, will you deferred tax? 100, 500, 100, 500, 520. Right? Deferred tax. Deferred tax is mentioned under the non-current assets. Right? Deferred tax 300, 100, 120. Right? This is how we used to mention, prepare, show in the statement of financial position. Okay. Okay. So we have completed the sum number 3. Here, this working is necessary to get the current tax from there. This is necessary. This calculation is necessary. This calculation also necessary for this. Right? This is continuation of number 2. Number 3 is continuation of number 2. So except this portion, we use everything workings here to here. Okay. This working taxable profit, tax, current income tax, we have calculated here. Here current income tax 100 by 100. So use this workings also. Right. Okay. We will move to number 4. Question number 4. So please take down this. Right. We will go to the number 4. Number 4. Beta buys an asset, right? Beta buy an asset for 1,500,000 at the start of the financial year. The asset has an estimated life of 6 years and an estimated residual value of 30,000. Capital allowance are available at a rate of 25% reducing balance and the tax rate is 20%. Right? So calculate the deferred tax asset and liability to appear in this thing for 2015 and 16 and 17. So we will raise this one. Okay. I will raise this one. Okay. Question number. Now question number 4. Question number 4. Right. Question number 4. This is beta buys asset for 150,000 at the start of the financial year. The asset has an estimated life of 6 years and the estimated residual value of 30,000. Capital allowance are available at the rate of 25% reducing balance method and the tax is at the rate of 20%. Okay. So we have to calculate for 2015, right? 2015, 2015, 2016 and 2017. Okay. Only the asset value is given. Right? For the asset only we have to. So carrying value. Right? Carrying value. And tax base. Tax base. Tax base. Carrying value and tax base. Then you will go to the deferred tax difference. Right? Temporary difference. Deferred tax. Right? Right? And deferred tax point. Right? Deferred tax tax liability T or asset. Deferred tax liability or asset. Okay. Thereafter, we have to prepare a statement of uh, movement in deferred tax. Movement in deferred deferred tax. Okay, movement in deferred tax, that is 2015, 2016 and 2017. Movement in deferred tax, that is closing balance minus opening balance, right, that is equal to movement in deferred tax, right. Now they says, but they said they buy 150,000, right, and residual value is 30,000. Asset depreciation calculation of depreciation, right, depreciation, that is cost is 150,000, right, minor residual value is 30,000, equal to 120,000, right. This is divided by 6 years useful life, then it is 20,000 per year, per annum, right. Depreciation is 20,000 per annum, right. Calculation of tax allowance, calculation of tax allowance, the tax allowance, you will say 150,000, that is 2015, 2015, right, 2015, 150,000 into how many percentage, 25 percentage, right, 25 into 25 percentage, then how much, that comes to 37,500, 37,500, then if you deduct 112,500, right, this is on 2016, right, into 25%, then how much, 28,125, 28,125, right, how much is the balance, 84,375, 84,375 into 25 percentage, how much, 21,094, 21,094, then 63,281, 63,281, this is the tax base, this is the tax base, tax base, right, this is tax base, right, tax base, then carrying value is 150,000 minus 20,000, that is 130,000, 130,000 minus 20,000, 110,000, 150,000 minus 20 is the depreciation, I am deducting the depreciation, again depreciation, it is the straight line method, right. Tax base is 112,500, 112,500, and this is 84,375. 84,375. This is 63,281. 63,281. Right? Temporary difference is where how much is the 17,500, 17,500 and 25,625, 25,625, 90,000 minus 63,281 is 26,719. 26,719. Right? If you deferred tax portion is 20%, right? 20%. If we multiply by 20, then 3,500, 3,500 and 5,125, 5,125 and 5,344, 5,344. Right? Deferred tax liability or asset, because carrying value is greater than the tax base. Carrying value is greater than the tax base. Therefore, it is the as a current liability. Current, this is a liability. It is the liability. Liability. Right? Here also, current value is greater than the tax base. Tax base. Right? Tax base. Then this is the liability. Right? Current value greater than the tax base. Here 90,000 is greater than the 63, no? This then liability. Right? Liability. In the deferred tax, we will say closing is 3,000, 3,500. Right? Opening no. Then 3,500. Closing become a opening 3,500. So 5,000 closing is 5,125. Closing here is opening 5,125. Then it become a 5,344. What is the difference? Right? 1,675. Right? This is 9 1 290. This is 290. Right? This is the movement in deferred tax. 2,000, 3,500, 1,675, 290. Right? This is the answer for the question number 4. Okay, have you understood? Because here they haven't given the turnover, profit before tax. They haven't given, so we don't need to. We cannot prepare the tax. What you call statement of profit and loss, right? So this is the attached to the deferred tax for the depreciation. Okay. So if we want, we can mention this one in the liability, right? Okay. So I hope you would have understood this fourth one, and we will work out for the next question is number 5. Question number 5, right? Revaluation. Question under the revaluation. That is, Pierre bought a property for rupees 500,000 on January 2015. On January 2015, on January 2015 purchases. Purchases how much? 500,000. 500,000. Okay. And on 31st December 2015, the property had a carrying value of 470. On 31st 12 2015, it had a carrying value, right, of how much? 470,000. That means we had a depreciation. 30,000 was the depreciation. That is depreciation. Right? Depreciation. That's revealed. And this is balancing figure. Okay. This is balancing figure. Okay. So on 31st December 2015, property had a carrying value of 470,000 and was revalued for 800,000. This had been on 31st of December, right? 31st December to 2015. It is revalued for how much? 800,000. 800,000, right? 800,000. This had been revalued for 800,000. So difference is revaluation surplus, right? Revaluation surplus take place 330,000. 330,000, right? 330,000. This would have been charged to the other comprehensive income, or OCI, other comprehensive income. Right? Other comprehensive income, 330,000, right? And revalued to 800,000. The tax return value at 31st December 2015 was 420,000, and the tax rate is 20%. Tax return value means 420,000, that is tax base. Tax base 420,000, right? This had been tax return value, and fair value was fair value is 800,000. Right? 800. Fair value in the sense revaluation, revalued amount, right? Revalued amount 800,000. Nah? So temporary difference. Then temporary difference. How much temporary difference? 800 minus 420. They have given in the question itself, they have given the tax base. That means tax written value of the asset. Tax written value of the asset, that is tax written value. Right? So tax base they have given in the question. We don't need to calculate the tax base, right? So temporary, that means 800 minus 420, that is 380,000, right? Temporary difference. Therefore, deferred deferred tax deferred tax deferred tax point, right? Deferred tax is at the rate of 20%, right? 20%, 38 and 76,000. 76,000, right? 76,000. This is the step 1. We have to identify the temporary difference. Step 2 is uh, deferred tax calculation. Step 3 is we have to identify whether the deferred tax is asset or liability. Okay, or asset, right? That means carrying value, this is the carrying value. Fair value is the carrying value. Carrying value is greater than the tax base. Carrying value is greater than the tax base. Therefore, it is the liability. Liability. Right? It is the liability. Right? So, we have calculated the deferred tax and liability. Now, we have to see how it is presented in the statement of financial position, and statement of profit and loss account. Statement of profit and loss account. In the statement of financial position, under the non-current assets, we will mention, right? We will mention the property, plant and equipment, 800,000. 800,000. Non-current liability under the non-current liability, deferred tax. We will mention deferred tax of 76,000. 76,000. This will appear in the statement of financial position. In the statement of profit and loss account, we will say depreciation, 30,000. 30,000. How did we calculate? 500,000 minus 470. Right? That is the depreciation. And thereafter, we will get the profit before tax. Profit before tax, profit before tax, and thereafter tax, 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 profit after tax, right? Other comprehensive income, other comprehensive income, gain, gain is how much? Gain is 380,000. Sorry, revaluation surplus is 330,000, right? 330,000. Okay. Less tax, tax. How much? 20%. 20% on this tax is 66,000. 66,000. 66,000. Then we will get 0, 0, 0, 0. How much? 6 is 4 and 12 minus 6 is 6. 2. 264,000. 264,000. Okay. So accounting treatment is this. What you call accounting treatment. But accounting treatment is right. Right. Accounting treatment is deferred tax credit, provision, right? Credit. How much? 76,000. 76,000. Profit and loss account. Debit. How much? 30. 76 minus 66. That is 10,000. Right? 10,000. 76,000 minus 66,000 tax. Right? That is 10,000. Comprehensive, other comprehensive income, that is also debited, that is 66,000. 66,000. This is the balancing figure. This is the balancing figure. Okay. We will see whether we can view this in the camera. Yes, we can view. Yes, you can see up to this in camera. So this is the balancing figure, right? We will see this stuff. This is the balancing figure. Okay. In other words, we can say
This is a lecture movement if there had been no revaluation, okay? Because we've revalued it by 330, the tax on that 330 has meant that we now have a higher deferred tax liability. So if you so wish, in terms of your tax, assume that there's no other tax. I'm sure there would be within a normal exam question, but you've got there that 10,000 tax expense that's gone through profit or loss, okay? Wow. That's pretty tricky. So if you do see a revaluation, be aware that there may be tax or deferred tax upon it. If there is, focus on the revaluation, get that correct, and then don't worry too much about the revaluation. If you want to get the easier marks with regard to the tax, then just take whatever gain you calculate and multiply it by the 20%, and that will get you some easier marks. But don't let this be the big area that you focus on with regards to the standard on income tax and IAS 12. Focus on the basics, understand the essentials of the deferred tax. If you can do that, you'll do very well in any exam question. But your tax through OCI, which is it? The 66,000, and that clearly doesn't balance. So we need to put in a balancing figure. So that balancing figure is a debit to tax through your statement of profit or loss, which I think is that as 10,000. That 10,000 represents the normal movement that there would have been on the deferred tax if there was no revaluation. Okay, we can prove it. Watch. Because what we've got there is we've worked out the gain. We've said that it was 330, I think it was. We've got the deferred tax in there, was it is 66. But that 66 wasn't all of the movement. Okay. If we had had no revaluation, then to work out the temporary difference, that would have been 470 less the 420, which gives me 50. Okay, so carrying value versus tax base. At 20%, that gives me 10. That 10 is a deferred tax liability.
so this here this 10,000 we got it from the balancing figure, right? We have got this from balancing figure. 76,000 we have calculated the deferred tax, and 66,000 on 330,000 gain, that is surplus revaluation surplus, that 330,000 at the rate of 20%, that is 66,000, right? And the difference is 10,000. So we have set the balancing figure, but we can compute it and logically we can prove that is the 10,000. How do we? Because actually the Differ temporary difference is 470 we have taken, right? 470, right? That is equal to 470 minus what is the tax base. 470 minus tax base, that is 420,000 tax base. Then this is the temporary difference, that is 50,000, right? 50,000 at the rate of tax, sorry, tax will be at the rate of 20%, right? At the rate of 20% in the sense 10,000. This is the 10,000 profit and loss comes. This is the 10,000. 770 minus 420. That is the temporary difference. Right? That 10,000 comes here. Okay. So you would have understood the revaluation, uh, deferred tax rises when the revaluation take place. So and then income tax and the deferred tax will take place normal circumstances and revaluation circumstances. All the things we have gone through, and I hope that you would have gotten good idea on this deferred tax, SLAS, sorry, IAS 12 and LKS 12, right? So I am concluding this lectures, and I hope to meet you in next session. Okay, thank you.